Hello, accounting students. Today we're going to talk about corporations and what specifically it is that makes a business entity into a corporation. So let's go ahead and get started. First of all, we'll begin with some definitions. Our first definition is corporation. A corporation is a legal entity business whose owners have limited liability and ownership is distributed by shares of stock. So there's a couple of important factors in this definition. It is a legal entity. That is, a corporation is created by law. There is a legal process that you must follow in order to create a corporation. You have to file a charter with a state, and then ownership is represented by shares of stock. If you're a stockholder in a corporation, then you are an owner of that corporation. Just to give you an example, a large corporation like a Microsoft or an Apple or an AT&T will literally have potentially 1 billion shares of stock. So if you own one share of AT&T stock, you might own 1/1 billionth of AT&T. But you are still technically an owner of the corporation as long as you own some stock. And as talking about stock, there's different types of stock. Common stock is a share of ownership in a corporation that includes the right to vote for the corporation's management. Common stock is, as the name implies, the most common form of stock. And when you think of a stockholder and you think about going and buying shares of stock in a corporation, typically what you're doing is you're buying common stock. And that gives you the right as a stockholder to vote for the corporation's management at the annual meeting of the corporation. Every corporation will have a meeting once a year, and one of the things in that meeting is for the stockholders to vote and pick the board of directors for the corporation. The board of directors then will actually pick the people who are going to actually run the day-to-day operations of the corporation. You know, people like the chief executive officer, the chief financial officer, all the vice presidents, and that sort of thing. So that's common stock. There's also something called preferred stock. Preferred stock is non-voting. Preferred stockholders do not have a say in that annual meeting on picking the management of the corporation. However, preferred stock does have priority over common stockholders in the payment of dividends, or if the corporation should go out of business and the value of the assets are going to be distributed among the owners of the corporation, then it is the preferred stockholders who will have precedence over common stockholders. So I'll give you an example of how that would work. Let's say a corporation goes bankrupt. It can't pay its bills anymore, and it's going to just cease operations. Then what would happen is the corporation will sell all of its assets, and once it's sold all its assets, it will have to pay off all its liabilities. And then if there's any money left over after paying off the liabilities, the next people to get a share of the corporate asset value will be the preferred stockholders. And once the preferred stockholders are paid out, then if there's anything left, that would go to the common stockholders. More than likely, in a case of bankruptcy, common stockholders won't see a penny. Preferred stockholders may get something, but that only would be if there was enough asset value to pay off all of the liabilities of the corporation. A couple of more definitions. Treasury stock. Treasury stock is also non-voting shares of stock, and treasury stock are simply shares of common stock that have been bought back by the corporation. Occasionally, when the corporation is flush with cash, the directors of the corporation will decide to buy back some of their stock. When they do that, that makes the shares of stock that are still out there owned by people, it makes those shares of stock more valuable because you're reducing the number of shares outstanding, and as you reduce the number of shares, then that means that each share that's left over will have greater value. Sometimes when corporations buy back stock, it can be a little bit controversial, because sometimes it's felt like they're only doing that to help existing shareholders, which may be the top dogs in the corporation. You know, a lot of times the top people in a corporation will be major stockholders, and so when they start buying back stock, that makes their personal wealth increase in value because they are major stockholders in the corporation. Dividends are another important definition. A dividend is a cash payment that goes out to all the stockholders. That will go basically to both common stockholders and to preferred stockholders. And remember, when dividends are paid, you will not pay any dividends at all to common stockholders until the preferred stockholders have received their dividends. Preferred stockholders get the precedence on the payment of dividends. So once preferred stockholders get their dividend payout, then common stockholders will get theirs. But that dividend payout is made from the earnings of the corporation. And then finally, we have retained earnings. And retained earnings are corporate profits that are not distributed to stockholders in the form of dividends. So let's say a company makes a profit of $1 billion. A big corporation makes a $1 billion profit. They may choose to take $500 million of that dollar and pay out dividends to all of its stockholders. And then the remaining $500 million that was not paid out as dividends to the stockholders will be retained earnings. And the corporation then would use those retained earnings and reinvest that money into itself. They may choose to use that money to upgrade their equipment and their machines and all of that sort of thing. They may choose to use that money to give pay raises or bonuses to their employees. But retained earnings are what's left over of the company's profits after the dividends have been paid. And then there's something called stock options. A stock option is stock that has not been distributed, but which may be purchased later for a fixed price. Oftentimes, you can buy stock options, and for example, right now I think the price per share of AT&T stock is $25 per share. I may have the ability to buy an option to buy AT&T stock at $26 per share. Why would I want to do that? I would only do that if I believe that AT&T stock will go up in value beyond $26 per share. So if I have the stock option to buy the stock at $26 per share, even though right now the stock is selling less than that at $25, I would buy that option and then hold on to the option. So at some point, if AT&T stock should get up to say $27 or $28 or $29 or $30 per share, at that point I can exercise my stock option and get those shares for $26. And then I can immediately turn around and sell those shares of stock for the higher current price of whatever that stock is worth at that moment in time. It's a way to get a lot of money. Now, typically, stock options have a fixed period of time in which you can exercise them. You can't hold a stock option for 25 or 30 years, but maybe the stock option would be exercisable within a 1-year period or within a 6-month period, something like that. So you hope that the stock will go up in price and allow you to sell it then at the higher price. So that's stock options. And then diluted stock. A diluted stock is the value of the common stock that's outstanding, that's being held in ownership of people, plus the stock options. So a lot of times when we've looked at earnings per share of companies, we've looked at the income statement of companies, and one of the things they'll have at the bottom of an income statement for a corporation is earnings per share. That would be the amount of profit that each share of stock receives for that corporation. And you'll see earnings per share undiluted, and then you'll also oftentimes see earnings per share diluted. And when you see it diluted, that means that we're including the stock options which have not yet been exercised in calculating the earnings per share. The last definition I want to discuss is depreciation, and that's the amount of a long-term asset that is consumed in a short period of time. So this is when we're looking at big major assets, like here you have in the picture a big machine, or you see on the left-hand side a big excavator. A big machine. That excavator there may cost $150,000. Okay, and that excavator probably has an anticipated life of maybe 30 years. So what we would do, when we buy that excavator, rather than record that entire $150,000 expense at a single one time, we would divide that cost of that excavator over the anticipated life of the excavator. So if I think that excavator is going to be in use for 30 years and it costs me $150,000, I'm going to divide $150,000 by 30 years, and then that's the amount that I'm going to record as an expense on my income statement for that year. Well, let's take an example. Something might be a little bit easier. That machine on the right, let's say that machine on the right costs $100,000, and I anticipate that machine is going to last 10 years. $100,000 divided by 10 years is $10,000. So every year for the next 10 years, I'm going to list an expense of $10,000. That's the depreciation expense for that machine, $10,000 every single year for 10 years. And that's depreciation. It is an accounting, it's an accounting tool to basically distribute the expensive costs of a major asset over the life of that asset. And with that, we're going to go ahead and stop this video, and you're going to be looking today at an assignment that looks at different types of stock for a corporation. And go ahead and check Canvas, and let's get busy and get to work. We'll talk to you later.